Welcome, welcome, welcome. Thank you for joining us. This is video lesson 2 of the Forexia Pro education. Today we are going to be talking about changing perspective and why it's so important for one to change their perspective and see the failures from a different lens. See what you've been taught as a retail trader from a different side of the looking glass. And this is going to help by understanding what you're up against, you guys. You're not against some other person across the world that when you buy, you're not being linked up to that person that's selling, and you're not fighting each other out. It's not a fight between buyers and sellers. Although we've been taught that, and that's what is being perpetuated by mainstream media, brokers, and different hedge funds and institutions, we have to realize that Forex is a $5.5 trillion a day market, and there are big players in this market. So when us as retail traders come into this market with $100 account, $1,000 account, even a $10,000 account, these numbers are tiny numbers compared to the millions and millions of dollars that are being pumped into this market by liquidity providers or dealers. And that's what we're going to talk about today. We're going to talk about how every dealer, no matter, or I should say every broker, no matter what broker it is, connects to a dealer or a market maker. That is why dealers or brokers are so, or are allowed to advertise things such as zero spread or instant fills, instant liquidity. It's because they are being provided liquidity by liquidity providers or market makers. And you're going to learn really quick that all a market maker is a liquidity provider, someone that loans out money to a third party. So in this lesson, we're going to talk about and break down the brokers, how they connect to market makers or liquidity providers. We're going to talk about the purpose of a dealer, their main move or their main method of manipulation, the pump and dump concept. We're going to learn how trading is 90% emotion and why. We're going to discuss the retail trader mentality versus the dealer, and also how the dealer creates patterns in a micro and macro form in the market and why he does so. I'm not sure if you've heard of microcosm and macrocosm and how it plays out in nature and in the human body as well as human emotions, but it plays in the Forex market as well. So let's start with brokers and how they connect to liquidity providers. Here we have XM. XM is a broker that basically They advertise spread as low as 0 pips. They talk about no commission. And I'm not using XM as just because it has 0 pip spread or something. I'm using XM as an example because it's one of the main brokers that a lot of people go through. So they discuss spreads as low as 0 pips, right? And then they go on to talk about how they keep spreads as narrow as possible to aim to get optimal prices from all our liquidity providers. So, in this other tab, I have looked up the definition of a market maker. A market maker, or liquidity provider, is a company or individual that quotes a buy or sell price in a financial instrument. So, real-time prices are aggregated from liquidity providers in order to offer best bid and ask prices to clients. Clients. Who are the clients? We are the clients. Okay, so just imagine the market maker is at the top of the pyramid. Us as clients are at the very bottom of the pyramid. In between of the pyramid, in the middle, are the brokers and the institutions. So these brokers are connecting to liquidity providers as a third party for us to get into the market and for us to have instant liquidity in this market. But what is another job of the market maker, of the liquidity provider? His job is to keep liquidity in the market, is to make people, make the clients or us want to buy and sell. So he will be creating patterns in this market such as wedge formations and other patterns that make the retail trader want to trade and entice them to jump into a sell or a buy position. That is the market maker's job. That is the liquidity provider's job. And it's funny that very, very, very few people realize that your spread on any broker that offers variable spreads, and that's what XM is offering. They offer pips spread as low as 0 pips, but it's a variable spread. That means that the dealer, the market maker that is quoting the price, can open the bid and the ask and spread it out as much as he wants. And we'll go over that and why that is so crucial to understand in future lessons, why the dealer or the market maker opens the spread on you or on certain times, during certain times like news events and whatnot. So, we talked about the purpose of the dealer and how he creates different patterns in the market. I'm not going to go over exactly the patterns that he creates, but here's a good example. A clear wedge pattern. I'm sure a lot of retail traders saw this wedge pattern and saw the breakout to the upside and bought that big green bar right there, or bought the breakout here. And then what happened? The retail traders thinking that it's going up because what they've been taught as retail is that the breakout is very strong and continuous. So they think the breakout is going to continue to the upside. What does the dealer do? The dealer, for half the day, brings it up and then creates that M formation. We're going to talk about M formations in later lessons, but for now, he creates that M formation and then dumps price below where you might have bought at. And you can see he keeps price below there and probably hit your stop loss if you had your stop loss anywhere in here. So this is the job of the dealer, is to create patterns in the market and entice the retail trader to enter a trade by what the retail trader has been taught and by the patterns that the retail trader uses and knows. So our next concept is the pump and dump. And this is basically how the entire market works. In a nutshell, the dealer will pump the market up really fast and then slowly dump it. Or he will pump the market up really slow and then dump it very fast. And vice versa. So here we can see the dealer took the entire day to pump the market up, and then in just a few hours price fell to where it was originally at the beginning of yesterday. So that's how the market works in a nutshell. These pump and dump moves get your emotions spiked. So let's go over this a little more in depth. The dealer takes all day to pump price up to the 82.7 range, right? We started out at 82.0. Let's say we were buyers at 82. We waited all day and finally we're at 82.7 and market's in consolidation. We're thinking about closing out because our take profit is maybe at 82.8 or 82.9 or 83. We want those extra pips because we're greedy. We're greedy retail traders. And what happens? The dealer entices you, maybe entices you to buy more, get in more, and then what happens? Price dumps. He dumps the price on you in 4 massive candles, completely shifts the zone, all of this consolidation. It took 16 hours and price was still in that same price range in 16 hours. And then in 4 candles, price dropped 60 pips. So that's a pip a minute. In 4 15-minute candles, it dropped 60 pips. Unless you have gotten out of this trade already at right here as a retail trader on your buy, that spike would have happened so fast that you would have just kept looking at your screen not knowing what to do. And that's the dealer's job. That's exactly what he is meant to do. He is meant to scare you out of your position by spiking the market up or down. He can only move one way. He can only move either up or down. He can't move, some in loops or nothing. It's either going up or down. And when you see a big spike to the upside, or like this, a big spike to the downside, realize, whoa, the dealer just dumped. Where's the pump going to come? Because we know that's how the trends are made, by the dealer pumping and dumping price. And we can see right here, the pump again. Dump, pump. Pump, dump. That's all it is, you guys. And sometimes there will be news events that trigger volatility and create the same pattern. Pump, dump. And they'll be more volatile. It'll take less time. Price will move in a larger range in less time. So, we went over the pump and dump, and I deleted my stuff here that I was talking about. No way. Alright, that's fine. We were going to talk about the dealer and what he is, what it is. So, if you don't already believe me that, there's such thing as a market maker or a dealer, and you think this is just all made up, you're too bought into the mainstream media idea of how the Forex market works, that's fine. Go off into your fairy tale land and trade with your invisible lines. You're not going to offend me, okay? But just to show you that this is legit, and there are literally people at the top of the pyramid that are controlling an entire market. Here it is. Citadel Securities. These are market makers. An award-winning market maker. Citadel Securities. Award-winning, and then it says market maker. Making better markets for a better world. They shove this in your face, you guys. They're shoving it right in your face. And nobody realizes it. Nobody takes notice. About Citadel. Yep. So, I'm trying to find there's one that says, it's really funny. It says, making tomorrow's markets as well. Like they, yeah, here it is. Making tomorrow's markets. Yup. They rub it right in your face. And that's exactly what the entire mainstream media, all this stuff, is meant to do. They put it in your face so that you can't see it. You have the eyes to see, but yet you don't take notice of what's happening right in front of you. So, there are the pump and dump patterns, right? These pump and dump patterns happen on every time frame. So you could also say this is a pump and a dump. And a pump, and a dump, and a pump. And then these are micro pumps and micro dumps in a macro pump. Micro pump, micro dump. Micro pump, micro dump. Micro pump, micro dump. This whole thing is a macro pump. And this whole is a micro or a macro dump. Sorry, that's really confusing. You're going to learn why this is important, why micro and macro is important because it occurs throughout the market on different time frames, and this happens on different time frames because in order to use the same pattern and not be recognized, they have to do it in a micro and a macro form. And you can see microcosm and macrocosm can also be found in nature. It can be found in, in a lot of different aspects of the human being. And here's another great example of these patterns that are found on a micro and a macro scale. And let's check out odd JPY. We can see here's the micro dump, micro pump, micro dump, micro pump. Here this whole thing is a macro pump to a macro dump. So this is kind of confusing right now, and I promise you guys that you'll understand it in the future. But to help you understand it a little better, let's go to a higher time frame where we can see the same thing happening. So the micro pumps and dumps we were talking about happen here. You can see the same thing on a higher time frame happens. It's the dump and then the pump. It's that same idea that fuels the entire market. Here we can see on a weekly as well, it is the same thing. So here we have the micro pump, micro dump within the entire macro pump and macro dump. Here we have the M formation that we talk about. But yeah, you guys, that basically sums up microcosm and macrocosm in the market. For now, we're going to go onto it in more lessons. We'll learn more about it in future lessons, but just know that there are patterns being made within patterns, and the smaller the time frame, essentially the easier it is to get a better entry and exit. But the larger the time frame as well, it is easier to see the larger picture, the larger macro picture. So thank you guys for tuning in. Stay blessed, stay peaceful, stay abundant. Thank you guys. Have a great day.